Good afternoon, ladies and gentlemen, and welcome to the Primary Health Properties PLC investor presentation for the interim results for the 6 months ended 30th of June 2021. Throughout this presentation, investors will be in listen-only mode and questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Just click Q&A, type in your question and press send. The company may not be in a position to answer every question received during the meeting itself. However, the company review all questions submitted today and will publish responses where appropriate to do so. These will be available on your Investor Meet Company dashboard and you'll be notified once they're ready for your review. I'd also like to remind you this presentation is being recorded. Before we begin, we'd like to submit the following poll. I'd now like to hand you over to Harry Hyman, CEO, Richard Howe, CFO, and Chris Santa, CIO of Primary Health Properties. Thank you. Good afternoon.
Well, hello everyone, and thank you very much for that introduction, Paul. This is our first time on Investor Meet Company, so we're delighted to be meeting all of you virtually. We welcome the day when perhaps we can see some of you physically. And I thought just before moving into the detail of our presentation for the results, I would give a very brief overview of the genesis of Primary Health Properties and why I think it provides such a resilient source of income in the shape of its dividend. So more than 25 years ago, I discovered that general practitioners in this country, the UK, have their rents reimbursed to them by the National Health Service. And although the GPs were the tenants of medical centres, in fact, the payor of the rent was in fact the NHS, and with the NHS being an agency of the British government, that there was what I would call a disconnect between the covenant on the lease and the actual payor of the rents. And that arbitrage, as it were, the margin between what you can buy the lease for and what you might be able to buy a government gilt for, struck me as an interesting margin to bundle up and pay out to shareholders in the shape of a good, reliable and growing dividend. And so back in 96, we joined the AIM market, progressed to the main market in 98, became a REIT in 2007. And I'm very pleased to say that over the 25 years, we have a successful track record of growing our dividend in every single year, as we'll come back and describe a bit later in the presentation. The company has moved forward apace, and I'm just going to give you a brief overview of it. We are in fact the leading investor in flexible modern primary accommodation, not only in the UK, but also now in Ireland, where 8% of our portfolio is based. We're in the top half of the FTSE 250, the £2.1 billion market capitalisation, and over 500 properties valued at just under 2.7 billion. The key point, which I was referring to earlier, that is 90% of our total rent roll derives from government bodies such as the NHS or the Irish equivalent, the HSE. And given that our rent roll is 136 million, we have 100% occupancy or thereabouts and an average lease length remaining of some 12 years. This represents an extremely solid and stable source of income, which we can support a modest level of gearing on that typically ranges between 40 and 50%. I'm delighted to say that so far this year, we've paid out 2 instalments of our interim payments on our dividend, totaling 3.1p. We've already declared and we'll be paying the 3rd instalment in the 3rd week of August. And brokers estimate that we'll be paying a total dividend for the year of 6.2p, which is about a 3.9% yield at the current share price. Given that the contribution to that comes 90% from government sources, we think that is an extremely attractive source of very high quality income. Other important points that happened during the first half of the year is that we moved from being externally managed to being internally managed. So we're a completely conventional property company. We had some good results, which Chris will talk about later on, from our rent reviews and asset management projects. And as the title of the presentation said, we have laid strong foundations for growth into the second half and on into 22. We have a very prudent level of debt finance at just under 41%. And increasingly, we are telling the story of our extremely strong ESG credentials. In fact, it's very difficult to think of a better example of social impact than investing in new medical centres. Our pipeline moving into the second half of the year is some £195 million spread across the UK and Ireland. In fact, 126 million euros of the pipeline is in the Republic. Since internalisation, we've also been able to carry out direct development, and I'm pleased to say that from the 10 million that we had in our balance sheet at internalisation. We've now moved forward to 21 million, representing 4 projects. We've also taken delivery of a number of projects, which I'll leave Chris to talk about later on. I've mentioned the LTV, and of course we have plenty of headroom with capacity of over 300 million, which should keep us going for the next 2 to 3 years. Of course, one of the consequences of the pandemic is that a number of parts of the property sector have experienced extreme difficulty on cash flow and cash collection. And I'm very pleased to say that we have a strong track record that shows the resilience of our cash flow. And we've collected over 99% of the due rents in the UK and Ireland for both 2020 and for the year to date. Of course, there has been some cash flow difficulty with some of the more marginal units like gyms and cafes. And of course, as a responsible landlord, we've stepped up to the plate and given those smaller tenants time to pay. Again, Chris will cover off the additional revenue coming from asset management and from rental growth. And I suppose the other point to touch on at this stage is that we are aware of the changes that the digital world is bringing, disruptive world is bringing, but so far we see no impact on the total capacity of primary care square footage. And indeed, we think in the medium term, the move of taking services out of expensive and inflexible hospitals and putting those services into the primary care arena is going to lead to a bigger demand for space across the portfolio, which of course we're in a great position to satisfy and service. And indeed, the move to integrated care systems and the new government health and social care bill is indeed emphasising this unified approach to care. And this should result in many, many more services, more diagnostics being located in the primary care arena, which will offset the reduced amount of square footage that may be needed through a lower amount of patient footfall from the initial stages of triage. But it's our view, having consulted with a lot of medical experts, that after the initial triage, a lot of time is still going to be needed for patients to visit the medical centre. And of course, we must remember that not everyone has a smartphone. And if you have aspects of dementia or of a number of complex conditions, then it's even more likely that you will be visiting the health centre yourself. I'm going to leave the more detailed aspects of this slide on the internalisation, which Richard will pick up on the annual savings of about £4 million that came or that are coming from it on an ongoing annual basis. And what it actually means is that we have a more simplified and streamlined approach, and it removes some of the differences between us and our competitors, and also widens the universe of shareholders, given that some were not able to invest in an externally managed business. Again, covered the principles of the pipeline, and we can come back to that a bit later in the presentation, but we have plenty to work on. And of course, it's not only new investments, we are committing a large amount of capital on an ongoing basis to keeping our properties fit for purpose and modernised. And Chris will pick that up in the section of the presentation about asset management. Here are some of the forward funders that we're working on, just to give you illustrations of the type of properties that we're involved with. At Eastbourne, we have a new £8.5 million building, which is reaching practical completion either today or tomorrow, topically. It's got a number of services that are designed to accommodate or deal with the population of Eastbourne, which has got a high level of elderly people. A lot of people go there to retire. And equally at Enniscorthy and Arklow, 2 pretty large new medical centres in Ireland, and we'll come back and talk about some of the differences between the Irish system and the British system. But the key fact there is that the HSE, or Irish NHS, probably accounts for 85% of the rent of our Irish portfolio. Great new buildings coming up, and they'll be finished in the first part of 2022. The developments that I talked about at the beginning, here are 4 of the ones that represent our development pipeline. Because of confidentiality, we don't give you the precise locations, but the one on the left is going to be located in Lincolnshire. The one second left is on the coast in West Sussex, and we have 2 within the urban setting of London. And we have a wider pipeline of 125 million across 17 other projects that are in our sort of stage 2 of work in progress. So having said that, I'm going to hand over to Richard, who's our Chief Financial Officer, who will take you through some of the key financial highlights for the year so far. Over to you, Richard.
Thanks, Harry, and good afternoon to everybody. I suppose just before I start, just to touch on PHP's dividend policy, we like to pay out a dividend in 4 quarterly instalments each year, typically in February, July, May, and lastly in November each year. But the key for us is that dividend is fully covered by our adjusted earnings, which is basically our rental income, less all of our underlying costs, such as interest and admin expenses. So last year, we saw a big improvement in our profitability over the 6 months, an increase of just under £5 million. That was driven by 2 key factors. One was the additional income from rentals, mainly rent reviews and asset management projects, which Chris will touch on a bit later, but also from acquisitions that we made in 2020 and a number of developments that Harry's already talked about that came online, completed in previous years. So that added around 3 million out of that £5 million. We also internalised the business, as Harry mentioned, and that's delivering around 4 million per annum of cost savings. So we had in the first 6 months of this year, £2 million of that came through, and that was the difference in terms of the increase in the profit in the first 6 months of this year. So that led to an adjusted earnings per share, 3.1p. That was all paid out to shareholders, 2 quarterly instalments of 1.55p each, and that represents a 5% increase over the dividend paid in 2020. The investment property portfolio was valued at just under £2.7 billion, and we saw some strong revaluation gains in the period, just under £67 million. That was driven by 2 key factors. One is the rental growth that's coming through our portfolio, the key driver for ongoing revaluation surplus, but also we saw some very strong yield compression in our sector. It was very attracted by the strong fundamentals. This sector is very secure, long income streams. There's a lot of demand from investors for this sort of income product as opposed to other property assets such as retail or offices. So we have an adjusted net asset value of just over 115p. That was up 2.5p in the 6 months to June, driven by 2 things: that revaluation surplus of equivalent to 5p per share, and then we also internalised the business, which at a cost of £37 million, and that knocked off around 2.5p. As Harry's already mentioned, we have a relatively modest loan-to-value ratio at 41%, and we target a ratio between 40 and 50%, so we're at the bottom range of that target. We do perhaps like to leverage slightly higher than most other real estate companies, but that really reflects a very strong income stream from our portfolio. Growth on rent reviews, looking at the property management of the portfolio. Chris will talk about this a bit later, 1.5%. We have a very long average lease length, just under 12 years, and we have pretty much full occupancy at 99.7%. Our EPRA cost ratio, this is really a measure of our sort of cost efficiency across the portfolio, is now down at 9%, and this is by far and away the lowest in the whole of the listed UK REIT sector. And the next property company on the list is a company called Assura, a similar company to us, and their ratio is up at 13%. Average cost of debt, 3.4%, but we have a very low marginal cost of debt at around 1.7%. So every time we borrow more money, it's only costs us 1.7% when we buy a new asset. Just looking at the debt portfolio of the group in a bit more detail, we like to borrow on a secured basis. We think that's the cheapest and most efficient route to sourcing finance at using the leverage ratios we operate at. But we have a very broad and diverse range of lending partners. We have Aviva with over £500 million of debt, probably our biggest lender. But we also have a number of revolving credit facilities with high street banks. They provide a lot of flexibility to us. Every time we have spare cash, we like to pay down those facilities. And when we want to buy a property, we have instant access to funds. We also have a range of other bonds and long-dated private placement loan notes, which provide us with some very long secured sources of finance. We also have, good to have some euro-denominated assets. We have some euro-denominated debt to hedge out the foreign exchange risk on those assets. If you look at the debt maturity profile at the bottom, you can see we've got quite a broad spread of maturities. So we don't have any huge waterfall or risk of any refinancing in any particular year. If you look at the 2021 and 2022, we've already agreed terms to renew these facilities, and those are being documented at the moment. We're working very hard with a number of our lending partners to look at our cost of finance and try and reduce this even further. As Harry's already mentioned, We have over £335 million of undrawn cash and loan facilities, which provides a lot of headroom to deal with our future pipeline of acquisitions and future projects. So at this stage, I'm going to hand over to Chris, who's going to take you through the property portfolio.
Great, thank you, Richard, and very nice to meet you all and be able to speak to you all. So just here on slide 13, 12 maybe even, we just give an overview of the portfolio, and I think one of the key points to note here is that this portfolio is largely built properties that are already rented. They're standing investments. We've got 514 buildings across the country. It's a very granular portfolio. We're across the UK. We're not in Northern Ireland. We are in Southern Ireland or Ireland, where we have 19 properties. These are largely buildings that have been built all really in the last 5 to 10 years. It's a very new and modern portfolio. It's part of a programme with the Irish government, and we're really very pleased with that portfolio as well in Ireland. The entire portfolio valuation, 2.65 billion, a contracted rent roll of 136.1 million. That's probably across something like over 1,000 different tenancies. And we have a net initial yield from that portfolio of 4.7%. A couple of other key points just to note here: the average lot size or the average value of our buildings, 5.2 million. We think that's right in a good place. We have about 50 buildings which are valued over £10 million, and we have very few buildings valued under £1 million. And the reason why we think that's important is that the buildings under £1 million tend not to be your purpose-built buildings. They tend to be your older converted buildings, and so we're pleased that we only have a very small number of those in the portfolio, and that the portfolio really is modern, purpose-built premises. The high occupancy rate, 99.7%, and as mentioned before, 90% of the income comes either directly or indirectly from the UK or Irish governments via their health services, the NHS or the HSE. I think perhaps one thing I'll draw your attention to on this slide is the wagon wheel in the bottom right-hand side, which gives you an idea of the spread of our lease lengths in the portfolio. So we have probably just over a quarter of the portfolio has more than 15 years left on the lease on the top left-hand side or the northwest of the wagon wheel, and less than 5% of the portfolio has less than 3 years left on the lease. So we have a weighted average unexpired lease term of 11.8 years of rent from the lease contracts, and that's the spread from 0 to over 25 years. So that's something that we actively manage. We have a team of asset managers, an asset management team, who are there and actively engaging with the occupiers of our properties to make sure that the buildings remain fully occupied and that they're fit for purpose, both from a clinical standard and from an environmental standard, and that our tenants stay with us. It's very important that our tenants and our occupiers stay with us and want to stay with us and renew their leases. So we do generally engage with our occupiers at least 5 years before their leases end for a number of reasons. We think it's good practice. There are also a number of stakeholders that are party to the decision of our tenants to renew. The NHS is the payor, as mentioned earlier, so they are part of that process. So that's something that we have a team of 8 to 10 people focused on, and we have grown the rental income across the portfolio through doing this and rent reviews by 1.3 million in the first half of the year. So that's a 1% increase across the entire rent roll of 136.5 million, and they were from rent reviews and asset management. Rental growth was positive from rent reviews. On this slide here, we just give an overview of the history of the increases in our rents from rent reviews over the last 15 years. Before I talk about that, we should note that about 70% of the portfolio has a rent review basis every 3 years, so open market rent. Actually, it's every 3 or 5 years, mainly 3 years, but some to 5 years. But the point is 70% have a link to an open market rent. And the remainder of the portfolio, 25%, is linked to an index, an inflation index, CPI, RPI, or Irish CPI. And the remaining 6% have predetermined uplifts already specified in the lease. And so this is a key way in which we grow the revenue and the income of the company. And you can see here on this chart that over 15 years, we've continued to deliver positive rental growth year after year. It's not as high now as it used to be, but we continue to see positive growth. We saw 1.5% increase in the first half of the year, which we're pleased with, and that's a mixture of those different drivers, and I hope to see that continue in the second half of the year and beyond. So that accounted for about £1 million of increase in the first half of the year, from something like 231 rent reviews. As you can imagine, with over 1,000 tenancies, we have a lot of rent reviews. We also are working constantly with our occupiers, as I said, to make sure that the buildings are up to the good standard from an operational and from the environmental point of view too. And we've given some examples here of just 4 of our projects that we have on site at the moment. So far in the first half of the year, we've completed 17 similar projects, not all exactly the same as this, but a sort of similar vein. And really, I guess the way in which we could characterize these are existing buildings. They're either during their lease or approaching their lease end. And we are in negotiations with the occupiers to often expand and extend the building. So this example here in Leamington Spa, we're extending the building by 20–30%. This enables the occupiers to provide more services. The drivers behind that often being that they were operating perhaps at full capacity already. They need to spread out a bit more. They need some more accommodation. But also some of the drivers we've talked about in terms of population growth, particularly in somewhere like Leamington Spa. There's been a lot of new housing development coming through, and new services being provided as well. As the healthcare system, like any system, continues to innovate and provide new services. We start to see some services that could have been provided in a hospital now provided in a medical centre. And this continues to drive the need and the demand for more space. And at the same time as doing this, we also refurbish the buildings in terms of the heating, the insulation, the energy efficiency, and so on and so forth, to mitigate their impact on the environment, reduce energy consumption. And this is measured through EPCs, I suspect we're all familiar with. And we target generally all our buildings to be upgraded to an EPC of B during this process. And finally, I think I'll just point out here that we have a number of policies and targets towards the environment. The NHS itself, our key occupier, has stated that it wishes to be a net zero carbon healthcare system by 2045. And we support them in that goal. That goal is important to us too. So we've set some targets around refurbishing our buildings, around the specification of the new buildings that we build, and in terms of how we operate the existing buildings. To reduce emissions, we've set ourselves a target to reduce our emissions by 25% by 2030. And that's just an example of our impact and how we seek to mitigate our impact on the environment. And as Harry mentioned at the beginning of the conversation, we're also always looking at our social impact. I mean, aside from the fact that we are providing modern purpose-built medical centres for the dispensing of 21st century healthcare, which we think has a very good and strong social purpose. We have also established recently a community impact fund and allocated some money to that to also go further in terms of supporting the communities in which we are invested and investing. So I will pause there for a moment, and I think that gives us a bit of a whistle-stop tour of the portfolio, and hand back to Harry to talk about the dividend and wrap up.
Thanks, Chris. And of course, a copy of this presentation is on the PHP website for later, phpgroup.co.uk. Anyway, this is a chart that we're extremely proud of and shows our 25-year track record of paying an increased dividend in each year. I referenced at the beginning that at a 160 share price, it's just fractionally above that today. The yield is 3.9%. We've mentioned that we pay out our dividend in quarterly instalments, February, May, August and November. The August one is still to come, but the shares are ex-dividend. So the next one after that will be in November. And I'm not allowed to tell you what that dividend is going to be for obvious reasons, but our brokers are estimating, very highly skilled financial analysts, that 4 times 1.55 is 6.2. And I'll leave you to predict the likelihood of that being the case. And as Richard was telling you earlier, dividend cover is pretty much at 100%, notwithstanding the fact that we raised £140 million worth of new equity last September. So a good track record. We consider ourselves, in America, they have a phrase called dividend aristocrats, and that's what we think we are. And it's vitally important and we have a number of shareholders that are income funds and high net worth wealth managers and things like that. It's a difficult slide to read, I appreciate, on the screen, but let me just say some concluding remarks. Of course, we take our hats off and salute the excellent work that the NHS has done in the UK and the HSE has done in Ireland in the fight against the pandemic. And I think it has shone a spotlight on the need for resilient and robust healthcare systems. And that is not likely to go away. You know, the demographic drivers for this business, an aging population, a growing population, a population with an ever higher incidence of chronic disease, like type 2 diabetes, which is very much in the news, connected with diet, coronary heart disease, and now the added pressures of COVID, long COVID, the vaccination program, the booster program, all mean that there's an ever increasing weight on the healthcare systems. And one of the best ways of the runners of those systems is to cope with this increased demand is to put more of it into the primary care arena, better value for the taxpayer, more convenient for the patient. But you can't do that out of clapped out, semi-detached and terraced houses. It has to be modern, purpose-built stock. So we've risen to the challenge. We've built up a portfolio of 2.7 billion with a really strong cash flow, 90% backed by the British and Irish government, a long WALT, a relatively modest level of leverage. We see a lot of merit in the Irish market, bigger lot size, longer leases, slightly different lease structure, but less competitive, frankly, than in the UK at the moment, where there are a number of pressures, and we're very keen not to be seen to be overpaying, and we want to make sure we get value for money for our stakeholders. The internalisation has been very good for the business. As I mentioned at the outset, it's widened the network or universe of potential investors, and we have a very additive business model where every single unit that we buy enhances the bottom line. We have a strong track record. We're highly committed to the business. We've got a great team of 55 people, 56 people involved in running it. We have a REIT structure, which is a very, very strong structure from a tax standpoint, and is a very effective way of private individuals, either through a SIP or an ISA, of owning property with very little tax drag. So those are my concluding remarks. I'm going to hand back to Paul, who's going to take you through some logistics, and then we'll come back and answer your questions. Thank you very much for your attention so far.
Fantastic, Harry. Thank you very much. Harry, Richard, Chris, thank you indeed for the presentation. Ladies and gentlemen, do please continue to submit your questions using the Q&A tab situated in the right-hand corner of your screen. But just while the team take a few moments to review those investor questions submitted already, I'd like to remind you that recording the presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard on the Investor Meet Company platform. I'd also like to remind you that your feedback is important to the company, and immediately after the presentation has ended, you'll be redirected for the opportunity to provide your feedback in order that the company better understand your views and expectations. I guess, Harry, I'll probably just address these to you, but we've had a number of questions that have come in from investors during the presentation today. If I may just hand back to you just to click on that Q&A tab and start at the top and just read out the question where appropriate to do so and give your response, that'd be great.
Yeah, fine. Thank you very much. Some really interesting questions. So thank you, Simon, for your question about how competitive is the investment landscape for acquisition, stroke development, and are we seeing this being more competitive due to the robust rentals? Well, I think the short answer is that in the UK it is very, very competitive. And as I said in my remarks, we're very keen not to overpay, but having the Irish dimension is quite useful. And in the slide deck, we have an interesting, slide 21 shows you on a sort of pretty academic basis the difference. So in the UK, if we were able to buy stock at 4.7%, we take off the 10-year LIBOR swap rate and our average debt margin, you get down to a bottom line contribution of 2.4%, 240 basis points. But and actually we can't buy stuff at 4.7%, that's the valuation yield. If we were buying new stock, it would be much closer to 3.75% or 4%. Compare and contrast that with Ireland, where we can buy stock at around about 5%. That's kind of like where we're at on our pipeline deals. If you take into account the fact that the Euribor rate rather, is actually negative, and putting on the margin, which is actually about the same, you get down to a much higher contribution. So we really are focusing on our Irish portfolio because we think it's a fantastic opportunity, and our target is to grow that to around 15% of the portfolio. So around about 500 million sterling, between 400 and 500 million sterling. So next question. So that hopefully deals with Simon's question. We go on to Andy's question, which is, with 90% government-backed rent, what leverage do you have on rent term and any increases you can get through? And I'm going to ask Chris to deal with that and describe the district valuer process and the appeals process. Please, Chris, over to you.
Certainly. So we have about 70% of our portfolio is linked to open market rent reviews. And in that process, the occupier is represented by the district valuer. So the district valuer is an advisory body, it's a subsidiary of the government, of HMRC, and it will advise the occupiers, the medical tenants, the doctors and the practitioners on the rents and the fair rents they should be paying. And actually, this is quite comforting to us because these rents are opined on by the district valuer, and we can't really be accused of having set prices which in any way are unfair. These are prices which the district valuer will opine on as being a fair market rent. But actually, at times, sometimes we feel the valuers and the district valuers may see themselves as protectors of the public purse as well, and they don't always give us what we think is a fair market rent. And then we have the ability to appeal. There is an appeals process with the NHS, and we have the ability to go through that. And in fact, we regularly do. We recently did it on a rent review in South London and Clapham, and we achieved the uplift that we were looking for there. And also recently in a property up in the East Midlands, where again we had a successful outcome, and the appeals process found largely in our favour. So that's something that is a core part of the work we do here. We have a rent review team which specialises in this, a team dedicated to doing this, and through that we feel they gather the expertise, the experience and the knowledge to be able to put forward our cases as strongly as possible for shareholders' benefit.
Great. Thank you, Chris. The next question, are tenants responsible, this is from Vivek, thank you very much, Vivek. Are tenants responsible for the cost of maintenance or fit out or refurbishment over the term of their tenancy? What is the typical cost as a percentage of the building value with respect to renovations and such if the tenant leaves and as such works more cosmetic in nature or more wholesale changes to the design and format of the building? Well, there's a lot of questions there, Vivek. I'm going to attempt to answer them. So around 60% of our portfolio is FRI, fully repairing and insuring, triple net, where the tenant is responsible for maintenance. 40%, and the entire Irish portfolio, so included in that, is what I would call FRI. Actually, it might be 45%. Sorry, it might be out of date on my statistics. And there we are responsible for the exterior maintenance of the building, but the tenant remains responsible for the interior. And that typically costs, or the budget is about 4 to 5%, of which we're currently spending 2 to 3%. So we're fine on that. And obviously, as a professional landlord, we want to make sure the buildings are maintained and planned maintenance is adhered to. And in fact, that's mandatory under the Irish leases. What does it cost in terms of a refurb? Well, it depends what the nature of the refurb is, and it can go from what we might describe as a light tart-up of interior renovation to building some additional rooms. Typically, it's 1 or 2 years rent, and it could enable us to get an extra 20 years lease extension, and you don't need a calculator to work out that that's a pretty good deal, Vivek. So I think that deals with that question. Thank you very much for Nick for saying it's a great business. We agree with you. What limits or issues, if any, do you face in growing the portfolio, and are ESG demands having any impact on returns? Well, this is a very interesting question. I think the constraining factor is the pace at which the NHS and the HSE work, the fact it's very fragmented, very localized, so it is difficult. And I'm fond of saying you need patience, PATIENCE, as well as patience with a TS in order to operate in primary care. And on an ESG, I'm going to ask Chris to answer that because it's very topical. So Chris, why don't you deal with the second part of Nick's excellent question?
Yes, indeed. So at the moment, I mean, I think one thing I would say about our buildings as well is that they are relatively straightforward. So they're relatively simple buildings. They're 2-3 stories. They're in a number of situations not actually air conditioned, which is actually one of the most expensive parts and energy intensive parts of buildings. And that is because the NHS doesn't actually reimburse doctors for their air conditioning. So they're naturally ventilated. And so we have about 82% of our portfolio has an EPC rating of C or better. So we think that actually from the point of view of getting that portfolio up to an EPC of B, which is where the government is currently consulting on by 2030, these are affordable costs which can be spread over time. That's something that's very doable. In most situations, it's again comes back to the negotiation with the DV about the rent. And I think we're at the beginning of that journey of negotiating with the district valuer that the full impact of additional costs are being reflected in the rent we're being awarded. But like I say, we need to keep the scale of those costs in context anyway. It's not the shard that we're owning here. These are pretty straightforward buildings.
Thanks, Chris. I'm going to come to you in a moment. Richard, Douglas has asked, how concerned are we about the rising inflation prospects? And I suppose we should point out that 25% of the rent roll is actually linked to inflation. Maybe Chris, maybe Richard, you'd like to deal with this in terms of the hedging position of the company and any future exposure to rising interest rates.
Yeah, well, I suppose a number of different aspects to rising inflation. Inflation has a big impact on rental growth, with rent reviews being probably driven more. One factor that drives it is build cost inflation. So as inflation, especially in construction costs, starts to rise, hopefully that will result in higher rent review increases across the portfolio. The flip side of that is when we come to build new development properties, that might be slightly more expensive. So we do have to negotiate quite hard with the district valuer to get slightly higher rents to get those properties built. But on the debt side, with the rising inflation, interest rates might start to rise, but 100% of our debt portfolio is currently fixed or hedged out. So we have very little exposure on that side, on the downside risk to the group. But if interest rates did go up a lot, there's a healthy arbitrage at the moment between the yield on our portfolio and government gilts, over 300 basis points. That may have some negative impact on the portfolio valuation, but we don't see that coming through because there's such huge demand for our assets at the moment. If anything, we'd see the values perhaps going up slightly in the future.
Thanks, Richard. Next one is from Chris. Well, thank you very much, Chris, for being a shareholder for over 10 years, and you, like myself, must be very happy. So thanks for having faith with us, and hopefully you'll continue for quite some time. Good question here about the short positions that have been in place for a period of for some time, of 2.5% of the issued share capital. And can we comment on it? Yes, we can. These are taken out by some convertible shareholders. We have a convertible in issue, and convertible shareholders split into two: those that are long only funds where they don't take a short, and those that are, as it were, convertible hedge funds, where in technical terms they hedge the equity exposure by taking out a short. It's a bit of a nuisance, and some people think it's a negative sign, but it's entirely technical, and we've had that checked out by our brokers. So I think the short answer is that we're not concerned about it, and other people shouldn't be either. So that brings us to the end of the questions. Fantastic. And I'm going to hand back to Paul.
That's absolutely fantastic. Harry, Richard, Chris, thank you so much. You've been very generous with your time for answering all of those, and have picked up pretty much everything, I think. In fact, yes. If there are any further questions that do come through, of course, the company will have the ability to review those. Perhaps before we redirect investors to give you some feedback, Harry, perhaps just a final few words, please.
Yeah, well, I think we've demonstrated that we have a really robust and resilient model. If you want something that is really socially good, having better equipped wellness centres, as perhaps they'll be called in the future, is absolutely vital. We recently did a freedom of information request, and astonishingly, in some London boroughs, more than 50% of the primary care stock is still converted houses. I just wanted to tell you a little story about a trip round a Glasgow medical centre. I went to see it after we bought it and asked the practice manager, a lovely lady, what the best thing was about the property. And she said, well, I won't attempt to do the Scottish accent because I get into trouble. She said, the thing is that we have fewer accidents in the medical centre, fewer injuries to our patients. I say injuries, surely they come here to get better. He said, yeah, but in the old property, there wasn't enough space for stuff, so we kept it all in the corridor. And she wasn't joking. She said the number of trip injuries has gone down quite considerably in our building, which just shows you that we need to have more properties like the one at Bray on the slide in front of you, and fewer like the terraced houses, or we had one over a chip shop that moved into a new medical centre in Swansea. But on an investment standpoint, our shares have robust and resilient income characteristics. We have a fantastically strong cash flow. We have a great pipeline. There's an enormous amount of capital that's required to modernise this sector. €1 billion needed in Ireland, £3 billion needed in Britain. And, you know, this was commented upon in a topical way by the Royal College of General Practitioners this morning, who in their 5-stage process that they wanted to ensure the viability of primary care moving forward, pointed to the need for £1 billion of investment in primary care. We actually think it's 3 billion, but no one can argue that it's a very large number. And we strongly look forward to paying our part in continuing supporting wonderful work the NHS and the HSE are doing and delivering healthy returns to our shareholders. So thank you very much.
Harry, that's absolutely fantastic. Thank you again for updating everyone. Richard, Chris as well, thank you indeed for updating investors. Could I please ask investors not to close the session? You'll be automatically redirected for the opportunity to provide your feedback in order the management team can better understand your views and expectations. This will only take a few moments to complete and is greatly valued by the company. On behalf of the management team of Primary Health Properties PLC, we'd like to thank you for attending today's presentation. That concludes today's session. Thank you very much and good evening.
Thanks a lot. Bye-bye.
Thank you.